Good afternoon and welcome to the Noble Capital Markets Virtual Equity Conference. I am Joe Gomes, Managing Director and Senior Analyst at Noble Capital. Today I have the pleasure of introducing Steelcase. Following the presentation, we will have some time for Q&A. Feel free to submit questions using the Submit a Question function. With us today from Steelcase is David Sylvester, CFO, and Michael O'Mara, Head of Investor Relations. With that, I'm going to turn it over to the company. The floor is yours, David.
Thank you, Joe, and good afternoon, everyone, and thanks for taking the time to listen to a brief conversation about Steelcase. Over the next 15 or 20 minutes, I'll talk a little bit about who we are and what we do. I'll share a little bit about the journey that we've been on over the last few years. I'll share some intel behind our midterm financial targets, and I'll also get into the strategy that we are driving to fulfill those financial targets. And after that, we'll be available for questions that you might have. At $3.2 billion of revenue in our fiscal 24 that ended in February, just 4 months ago, we are the largest office furniture company in the world. And that's compared to any of our public competitors or any of our international competitors around the world. And we've regained our industry leadership in a very dynamic environment that's been impacted by the pandemic and hybrid work. And that's happened even after consolidation in our industry. For those of you that don't know, some of our competitors, Herman Miller and Knoll, they merged 2 years ago. At the beginning of that merger, they were a bit larger than us, and today we've regained our leadership position. And more recently, HNI bought a company named Kimball. As we sell through 770 dealer locations with 65 Steelcase locations and regional manufacturing locations around the world and leverage a number of brands, most of which is Steelcase oriented. So we go to market with large enterprise, small to medium-sized businesses, healthcare, and learning through Steelcase. But we supplement those brands with a number of other organizations that we've acquired over the years that have expanded our product portfolio to serve customers around the world. And we think that this footprint that we have and the breadth of our brands is a unique capability in our industry. 30% of our revenue is outside of the US. We think that's as large or larger than any other competitor measured around what is their percentage of revenue outside of their home market. One way we differentiate that is been in our DNA for a long time is how we go about innovation. We have historically leveraged our own internal research team. It's referred to as Workspace Futures. And we also leverage a number of external partners, many of which are exclusive to Steelcase in our industry. And what we attempt to develop is foresight about worker, work, and workplace that informs our product development process. So each new product or application that we bring to market is founded in some level of research or insight that we developed. And so we're often referred to in our industry as the thought leader. We also design very beautiful products by well-known designers, but we're really positioning ourselves as the thought leader in the industry. We operate with a conservative capital policy, and we also have a dual class structure. Just for your information, you can see from the chart on the right at the bottom, we have operated with net cash as often as we have with net debt, and it's been pretty tightly bound inside a range of plus or minus $250 million. And you can see on the left, we have well over $500 million of liquidity or access through our credit facility. We operate with that conservative capital policy in part because of the cyclicality, but also to be opportunistic on acquisitions and on other strategic ventures that may come across our path. The dual class structure was put in place when we went public in 1998. You can see the Class B ownership has reduced from 91% to 18%. And for your information, it sunsets at 15%. Over the last several years, we've experienced quite significant volatility in our business. In fiscal 20, that's calendar 19 mostly, we had one of the best years we'd had in almost 2 decades. And following that, with the pandemic, of course, our revenue was significantly impacted as large customers pulled back on the level of investment in their offices, given that most of their employees were working from home. What we saw after that was dramatic, really extraordinary inflation, and significant supply chain disruption. I'll tell you, on the inflation side, we put 6 price adjustments in place, a few of which were double-digit in nature, and we did a surcharge over the course of 18 months to deal with that level of inflation. And the supply chain disruption at its peak was costing us more than $5 million a quarter just to deal with the multitude of suppliers that were not fulfilling their commitments to us on time. Since we've seen improvement in our results, that improvement has been driven by the pricing actions that our sales team was able to negotiate and get put into place with our customers. So while it initially had a negative impact on our earnings, on a cumulative basis now, we are offsetting the inflation that we've experienced and capturing gross margin on it. And for the most part, our supply chains have largely stabilized. Our customers also are beginning to invest, and I'll get into that in a little bit more detail in a minute or two. I'll also share that our current fiscal year, fiscal 25, that started in March, is off to a good start. Last week, we announced our first quarter earnings that were better than we expected. We also guided the summer quarter to a strong quarter, better than the investment community was expecting, which raised our confidence to achieve the targeted range that we had for earnings and revenue this year, and potentially even reach the top end of the targeted range of income. The investment thesis at Steelcase really revolves around 2 beliefs. The first one, which I think is core, is you have to believe that the office will remain strategically relevant, both for innovation, to support innovation, culture, collaboration, retention of talent, etc., and that customers will invest. If you believe that, then you can go to the next core belief. I'll give you a little evidence that we're starting to see things improve on this first one. Over the last 3 quarters, we've seen growth year over year in our order patterns at the Steelcase Inc. level. And what I like about the growth rates is not only the size of them, but more importantly is that it's starting to reflect both pricing and volume, because we have the tail end of some of the pricing benefits still coming in from the actions that we took over the previous 2 to 3 years. The second core belief is really that the execution of our strategy will enable our industry leadership to remain, and that we'll also achieve our midterm financial targets, which are to achieve 4 to 6% average annual organic revenue growth, reach an adjusted operating margin of 6 to 7%, and generate free cash flow as a percentage of revenue of about 5%. These are levels that we've achieved before. You can see if you look back at FY20, we're anticipating that we could, if we hit these targets, we could not only get revenue back to that level, but we could also get adjusted operating income and margin back to that level. The way we do that is by executing our strategy, which has 4 primary pillars. One is to lead the transformation of the workplace, and I'll talk about that. The other is to diversify the customer and market segments we serve. We want to also improve our profitability, and we want to use our business as a force for good to help the world work better. On the first one, leading the transformation of the workplace, this largely has to do with the brown or taupe shaded wedges of the pie on the right. This is for large corporate customers, government, and our own dealers, which sell everything to all of our customer verticals, but they're also mostly focused on large corporations. What we see happening in this segment is, first and foremost, CEOs and the executive teams are more and more beginning to mandate minimum numbers of days in the office. They've gone from thinking we'll leave it up to employees and teams to now mandating we want to see our employees in for a minimum number of days. Those companies that were early adopters of that are moving from 3 days to 4 days, or 4 days to even 5 days. Others that were indifferent and left it up to employees are moving to, you got to be in for at least 1 or 2 days. So that's a positive indicator of, I think, future demand potential. The other indicator is linked to what resides inside the four walls of the office. Prior to the pandemic, the driving design principle was density. I think companies were trying to get as many employees into the space as possible, leveraging shared desking, benching applications. And conference rooms were really designed to share information, not really to collaborate, and certainly not to support teams that were distributed throughout the day. So what we see happening is offices migrating from being installed on a dense model to enabling privacy for people that want to be able to do their focused work in the office like they've been able to do it at home. They want to be able to be on video at their workstation periodically, and conference rooms need to work much more seamlessly and efficiently to support great experiences for hybrid, which is really here to stay. We by no means believe everyone will be in the office 5 days a week at every single company. So we think hybrid is here to stay, but it needs to be a good experience on both sides of the camera. And we think we're seeing evidence of that changing. We think we can continue to grow our market share in serving these large corporations by being their trusted partner, by continuing to lead with innovation. We stayed invested throughout the pandemic in the future of how we thought people would come back to work. And that's what has helped enable us launching some collaborative suites that were co-designed with relationships with Microsoft, Zoom, Logitech, and others. And it also enabled us to bring screens and barriers, architectural pods to the open plan to enable a higher level of privacy. So innovation is a big deal, has been a big deal, and we've stayed invested to help continue to fuel that. What we've seen, again, is growth in each of the last 3 quarters. That was led by the Americas, and it was also led by large corporations or our enterprise customers. What we have seen among them is that first day-to-day business started to come back. So for 4 of the last 5 quarters, our day-to-day business began to improve year over year. And think of that as people getting back into the office, moves, ad changes, miscellaneous projects and initiatives getting done, driving demand. And what typically follows in a recovery is project business. We were seeing some evidence of that in our opportunity creation, our project quoting, our mock-ups. And what we've been seeing in our order patterns is that's also grown in each of the last 3 quarters. And we think that our fact that we stayed invested in this is supporting large corporations is what's helped enable us gain some market share over the last couple of years. On the diversification strategy, this really starts to speak to those first 4 wedges about small to medium-sized businesses, education, healthcare, and consumer. And what you can see when I compare that pie chart to fiscal 20 or pre-pandemic, it now represents a larger mix of the business. Now, some of that is because large enterprise has shrunk, but some of that is because we've had less of an impact in these areas. And in fact, some have grown since their base in FY20. We've done that by building on the momentum we have in education. We've been in higher education for a while. 3 or 4 or 5 years ago, we bought a company called Smith System that expanded our education business into K-12. Both of those parts of the education or learning team have done well, given the dynamics behind education. Pedagogy is changing, classrooms need to change. Higher education is faced with a shrinking student population, and therefore they need to invest to compete for the talent coming to their school. Small to medium-sized businesses, we've also saw that in the pandemic, when large company pulled back, we spent more of our sales energy focused on small to mid-sized businesses and found that we could grow that business at a faster rate than we had been with a little bit more attention and focus. So that's become an element of our diversification strategy. Health is a similar play, not necessarily the admin side. This is the clinical environment. This is us supporting waiting rooms, nurses stations, patient rooms, head walls in patient rooms, millwork and the like. That's an area we've been focused on for quite some time. We think it could have even more potential if we were able to bolt on an acquisition to that vertical market. And then we also play in the consumer retail world, but not in an aggressive way. It's really more about making it easier for some of the employees of our customers to purchase product for their home to create a great experience in the home office. Like I said, we've used acquisitions to help with some of these strategies. AMQ was one that helped our small to mid-sized business, and Smith System helped education. Here, we've also seen that as a group, these categories have grown in each of the last 3 quarters, and they've also played a role in us gaining market share in the Americas. Improving our profitability is largely about gross margins. The first and largest, most important thing was to capture pricing benefits on the hundreds of millions of dollars of inflation that we experienced. We've largely done that, as I said earlier. The next element is really about optimizing our footprint, our global operations, and that we've put a marker out there that we think we can save $50+ million across our cost of goods outside of volume-related benefits and outside of pricing over inflation. This is incremental by addressing our footprint and identifying opportunities to drive efficiencies. And we're in the early innings of that endeavor. We also are driving value through business transformation. This is in advance of a new ERP platform that goes live in March of 25. We are being forced to do this. Our current SAP environment will no longer be supported in the not too distant future, and therefore we're adopting a new SAP platform. But in that process, we chose to not just take what we were doing and put it in the new software. We decided to look holistically at our business processes and really ask ourselves the tough questions about where can we and should we be more fit to standard inside of SAP. And that again goes live in March. And then another practice that we've made really intentional efforts on is reallocating investment dollars, pulling dollars away from areas and investing them in other areas, which has been redeploying operating expenses and capital versus making it always incremental. And the last is regarding our sustainability strategies. We recently, last couple of weeks ago, announced our commitment to a net zero future by 2050. We had a carbon emission reduction goal out there. It still exists to reduce our emissions by 50% by 2030, and we're well on our way to do that. We made our commitment for net zero by 2050, in part because it's been part of our DNA for a long, long time, but also because we see a growing number of our customers that are demanding their vendors or suppliers, Steelcase, to help them in their sustainability goals as well. So that's the investment thesis. That's the strategy behind the investment thesis. If we can deliver 4 to 6% annual organic revenue growth and our profitability improvement initiatives, we think it'll go a long way to getting us back to 6 to 7% adjusted operating margin. And if we do that, we will generate a significant amount of cash flow. And therefore, I'll close with our capital allocation priorities. Our number one is about strengthening our overall business. So we invest 2 to 2.5% of revenue in CapEx, another 1.5% in research and development. We are acquisitive. mostly about revenue synergies, less about cost synergies. We, of course, look for and capture cost synergies in our acquisitions, but it's mostly wired to try to grow and strengthen our top line. And then from there, we have been consistently a dividend-paying company for a long, long time, probably 50 years or more. I imagine that will very likely stay part of our capital allocation priorities. It has, of course, moved around a bit with this extreme cyclicality that we've had, but it's never gone to zero in the last 25 years. And then we leverage repurchases to minimally offset dilution, but you can see in 21 and in 22, as well as more recently, we did more to offset dilution simply because of the ballast that we had on the balance sheet from a liquidity perspective, and the valuation that we felt we were trading at was far below, we thought, the true value of the company. So occasionally we are a bit opportunistic from a repurchase perspective. From there, I will turn it back to Joe for some Q&A.
Thanks, David. Great overview there. Let me start off the Q&A. The overall trend of employees returning to the office seems to be still a little bit sluggish by many metrics. And just seeing, what are you seeing amongst your customers, and how's the company reacting to that?
I would say better than sluggish. So we look at the various data that's out there, whether it's water consumed in the office, drinking water consumed in the office, or the badge data. But we also pay attention to our relationships that we have with C-suites. For example, we participate in Business Roundtable. We've been a member of that for a long, long time. Literally 100% of attendants at Business Roundtable want their people back in the office. Some are using sticks, some are using carrots, some are using bigger sticks or bigger carrots, meaning they're leaning into it more intentionally and aggressively because they're feeling the negative consequence of having such a distributed team. Their culture, their innovation, their speed to market, their retention are all suffering. So we actually see it starting not to accelerate, but it's starting to pick up where it had been kind of sluggish for the early part of the pandemic. And I think it's what's showing up in our day-to-day orders from large company, and our project business starting to show growth more consistently.
Okay. And you also you spoke of a trend of a desire for more privacy and enhanced conference room experiences. How does that impact things such as your average price per workstation or per employee?
It raises it. And it raises it. I mean, if you think of the benching application where you had 6 people working at a table with a low screen in between them, now you've got freestanding, often height adjustable desks with screens and barriers in between to enable some privacy. And there are more architectural pods, phone booths, and the like. So we actually see, while the number of workstations might be going down because of hybrid and not everybody being in on every single day of the week, what we see contrasting that is the dollar value per workstation going up.
Okay. And you talk about, during the COVID pandemic, supply chain disruptions. Have you taken any steps to hopefully prevent something like that occurring in the future? And if so, what steps were they?
Yeah, it's a good question. I mean, we took a lot of steps. Early on, we built inventories. We're strictly made to order. So what we did is increased our safety stocks dramatically, well over $100 million. As the supply chain stabilized, we've since reduced that. So that was managing through the chaos. We also leveraged air freight and other things to be able to keep delivering things on time for our customers. So we did all the necessary things, and then we also changed suppliers. So we went deep with some of our core suppliers and understood why they couldn't fulfill their commitments on time. And in those cases where we didn't have confidence it was isolated, we changed suppliers. And I would also say we insourced a number of things that we thought, okay, we used to do this stuff. We moved it out decades ago. the supply chain has proven a little unreliable. We looked at some investment potential and the payback of insourcing it. And so in some of the key core, let's say, component parts, we actually did insourcing as well. So we feel pretty good about where the supply chain is. I would tell you in the same breath, though, the supply chain really hasn't been tested yet.
Right.
Right. So if volume actually, this is one of the enterprise risk management things we talk about. Of course, we talk about all the bad things that could happen. What we talk about is what if demand actually started to accelerate because people really did lean into getting back to the office and modernizing their space? Would our supply chain be able to handle it? And what's our contingency plan? But we made a lot of changes. We feel good about them. It should be better. And we're preparing for just in case if demand were to increase more significantly.
Okay. We take another one from the audience. You mentioned an SAP system changeover. Upon what protocol will the new system operate, and will you evaluate changes in energy efficiency?
The last question is a good one, not one I thought about. We're moving to SAP S4. It's a cloud-based solution. And as I said, we are evaluating all of our business processes extensively. In fact, I would say we are in the high 90% fit to standard. Some of that is because the software has advanced significantly from when we first adopted it 30 years ago. Some of it also is our business model was stayed a little too complex, and frankly, we weren't getting paid for it by our customers. So we're standardizing some of those business processes. So I feel pretty good about the approach that we're taking. We're also, we faced a cyber attack inside of our business 2.5 years ago. We responded pretty effectively, but it was 3 weeks of pretty significant disruption. We didn't pay a ransom, so we were able to leverage our backup systems. We've invested more since then to be able to potentially recover, but we've also made sure that this new environment gives us even an advanced level of fortification. Not that we'll ever be able to say we're 100% protected, but we tried to make sure that we were that much more protected.
Thanks for the insight there. Can you talk a little bit about the health of your dealer network?
Yeah, that's a good question. They are well, I shouldn't say surprisingly, they have become very resilient. We in the early 2000s, we faced the first real meaningful downturn the industry had ever experienced. And we had a lot of dealer failures, a lot of dealer consolidations back then. When we went through the financial crisis, we had very, very few, because I think they learned how to adjust their business model very quickly. They've also learned to take advantage of customer deposits to protect against their banking relationships going sour in a potential downturn. So their balance sheets are in good shape. Their access to liquidity is good. Their behavior on getting deposits has changed. I feel like it's as good as it's ever been.
Great. Well, we're almost out of time, but let me sneak one more in here. You talked about, past M&A. Are you looking for additional acquisitions? If so, how is the environment, especially if you look at valuation perspective?
We are looking, as I mentioned, healthcare is an area could see us expanding our portfolio to further strengthen our growth potential in that particular market. It's not an easy market. That's a good vertical area. Those businesses that we would like to acquire are not for sale, so the valuations are a little steep, which is really why we haven't moved yet. We haven't quite yet convinced the right player that we'd be better together than separate. But give us time. I would tell you all of our acquisitions were strategic in nature. We went out and targeted someone, built relationships, talked about a strategy together, and ultimately acquired them. We look at hundreds of companies, it seems like a year, that are for sale, and we really haven't bought any of those because they come with lots of distress typically.
Well, we'll see how that plays out going forward here. That's all the time we have today. I really want to thank you, David and Michael, for joining us today. Great presentation. We look forward to seeing more about the Steelcase story going forward in the future. Thanks
Great,
again.
thanks, Joe.
Let's go.